Ladies and gentlemen, welcome back to the channel. In today's episode, we're going to actually be showing you some clips from CNBC that I think you really need to hear. These clips are like 3 minutes long. Skip past them if you don't want to listen, but these are some of the individuals that I put up there. Okay, most of Wall Street I put way down here. Like, most of Wall Street is down here. Retail investors are like right here as far as knowledge and understanding of markets. Like, you guys have a lot of understanding of markets on a deep level where a lot of institutions, hedge funds don't. Okay, they just don't understand how things work. But some guys I put like up here, and one of those is 314's research, Warren Pies, and he shared his opinion on markets. He says the stocks are going to trend higher into the end of this year. Now, I do have another clip I'm going to share with you as well, and we're going to get into my expectation of what's going to happen in this market into the end of this year, and really most importantly 2026. See, the focus is all on 2026 at this point. Like 2025, forget it, it doesn't matter. The story is about 2026. I know, crazy. We're talking 2026. I remember it was yesterday. It was 2020 and 2021 and 2022. Time is flying. So, yeah, let's go ahead and get into today's episode. Hit that like button as well as subscribe to the channel if you have not done so already. And let's get started. Okay, so before we get into my opinion, what I think is going to happen into the end of this year, but most importantly 2026, I want you guys to listen to what Warren Pies says. He says markets will drift upwards through year end. He has been incredibly accurate on kind of, guesstimating, if you will, where stocks are headed. So take a listen.
Warren, what a difference a few hours makes. Price action is really interesting. Maybe the market's just trying to suss out any kind of talking between the two sides is good news down in D.C., and maybe we'll get a resolution to the shutdown. So let's go positive and see what happens over the weekend.
Yeah, I mean, I think that it's a reverse of the usual. You don't want to, if there's potential for bad news over the weekend, you don't want to be long. I think the potential is for good news over this weekend, so people are closing out their shorts, and we'll see what next week brings. I think this has been a market that's really all about growth at this point in time and how that interacts with the Fed. And so you heard a lot about the restaurant stocks there, and just we've seen those types of consumer cyclical stocks really trade in a bad way post the last jobs report back in early September, while AI has driven everything in the market. And so it puts the market in kind of a vulnerable spot. And this recent pullback has happened right after the Fed meeting. So the market topped when Powell last spoke. And I think the market is really needing more Fed support. And so the Fed kind of tried to do that hawkish cut. And I think the market's throwing its tantrum. And this is really all about the bottom half of the K, that in that K-shaped economy, needing more stimulus ultimately. And so that's how I read it, and it's going through the market.
That's what you think this sort of the unsettled market is a result of? Not so much sort of questioning anything about the durability of AI or the spending amounts, the valuations of some?
I think it's about the Fed. So I think the Fed is so they're in a conundrum where they have this K-shaped economy, the bottom half, the real estate market, restaurants, consumer cyclicals. Anyone not in the top 1% really doesn't own assets. They're struggling, and then you have AI and the super wealthy or the ultra wealthy up in the top half of that K. So what they're in is this position where they have to stimulate to help the bottom half of the K, but when they do that, they also blow this bubble or kind of encourage a bubble behavior in the top half of the K in AI. And so I think it is all related, and it is back to the Fed if you look at price action. I don't think that we're in an AI bubble yet, and so it's just a matter of the fact that the AI basket we track is up 20% since the early September. I mean, these things have to take a break. And obviously, even strong earnings results weren't enough to power the group here recently.
I got 30 seconds left. The Challenger data this week was obviously concerning, but under the theory that you're telling me, that probably just means that the Fed is likely to continue cutting, and maybe December isn't dead just yet.
Yeah, no, I think they'll cut in December. It's a matter of what's the path going to look like through that. And I, when I zoom out, because of that Fed support and what the data is looking like, the data we have, the Challenger data, and all ADP data, private jobs data, I think the Fed's going to cut, and it's going to be ultimately an upward drift for the markets. I'd say bullish through year end.
Now, I agree with Warren Pies on a lot of things, but specifically where he talks about stocks drifting higher into the end of this year, I think I think that's pretty much a certainty in my opinion. But really, what I'm most bullish on is 2026. See, Wall Street right now, let's take a step back. Wall Street is really bearish. They're really negative. They're concerned about a recession. They're concerned about the government shutdown. They're, concerned about the Fed and what the Fed is going to be doing. In all reality, none of what I previously have called for has changed much, okay? Government's been shut down for a while, so we don't have the BLS data to really back this up with, per se. But I think we're in a situation where the economy is largely unchanged, whereas the estimates have gotten really bad, okay? So the estimates have gotten really negative on this economy. I think there is some pretty massive room for an upside surprise in economic data in the economy, and that sets us up really good for 2026. Now, I believe 2026 is a year that the consumer can start to recover. I think 2026 is a year where inflation starts to come down in a meaningful way, and that's going to be really good for equities. I think that's going to allow the Fed to cut rates. I think AI is alive and well. I think we are in the very early stages of AI, and I talk to members in the trading community about this all the time. Check that link out down below in the description of today's episode. But there's going to be many waves of AI. It's right now we're kind of in the GPU, semiconductor, halfway into the software phase of AI. I think there's more left in the software phase. That's probably one of the larger phases of AI where software becomes like big for AI investment. But it's going to get into autonomy. It's going to get into robotics. AI is going to hit healthcare. It's literally going to impact everything. It hasn't yet. Like we are in the very early stages if we're talking about, what AI has actually impacted and what the markets care about, okay? Is Wall Street talking about robotics? No. Is Wall Street talking about autonomy from a individual perspective or autonomy mixed with robotics? No. Is Wall Street again talking about healthcare? I think that's the biggest one to point to, because I think AI for healthcare is going to be revolutionary. Okay, we're not even close to talking about these things yet. Okay, you have gotten some hype around software, obviously semiconductors. That's been huge for years now, but there's many phases or waves of AI to come, and you're in the early stages of this. But I do think next year you're going to see a massive wave of AI adoption, innovation, and really deployment across the board. And even into like the end of next year, I think robotics and maybe autonomy starts to become more front and center with the AI story. So yeah, you want to be careful not to buy the highest flying momentum names in AI, but if you're buying sound quality companies in the software area or robotics or autonomy like we are, I think there's some pretty massive upside potential right around the corner. Now, we will break all of this down in a little bit more depth in just a moment. We'll talk about the end of this year as well. I kind of gave you the scoop for 2026. We're going to have a year where I think the economy is going to do quite well. I think the consumer is going to start recovering. The big beautiful bill and all of the tax changes and the policies that should benefit the consumer are really going to start to work their magic. Like no tax on tips, no tax on overtime. If you max out $25,000 of tips a year and $14,000 of overtime, you're going to save like $8,000. Okay, that's going to be extra money back to you. But what a lot of Wall Street does not talk about is the real estate market. Donald Trump today put out a little bit of a teaser on Truth Social talking about a 50-year mortgage. Now, that could definitely help spur the real estate market as well, allow people to get into homes at more reasonable, mortgage prices. And you can make an argument that that's not great either, but for the sake of, this video, I think it would be largely positive. Okay, I think that'd be something that would spur more sales of homes and get equity flowing. The problem really has been a lot of people have big equity gains in their home, but they have not been able to sell their home for years because it's too expensive to buy a new home. I think next year you're going to see the rates come down, or just a better word, I guess, but lending pressures subside a little bit, and that's going to allow up to $700 billion to flow in this economy into people's bank accounts that they can then spend. Okay, so consumer getting better, real estate getting better, kind of feeds into the two. AI is alive and well. I don't think the economy is nearly as bad as the markets are currently pricing in. This sets you up for an upside surprise next year. Okay, that's the bull thesis, in my opinion, for next year. Could I be wrong? Obviously. I think at some point next year as well, I should point this out while we're talking about bull theses, is you're probably going to have a moment next year where China takes the lead over America in AI. And that's going to be a big problem. People are going to freak out for a little while, but then it's going to look like very much a competition, right? Just forewarning, that's probably going to happen next year. It's probably going to be negative when it does happen, but that could be 6 or maybe even 12 months from now. That could be a while from now. And there is significant upside, in my opinion, in this market between now and then. Now, if you're looking at the headline S&P, sure, is there upside there? Of course. But I think the large opportunity is really under the surface in some of the stocks that we are investing in, right? The underappreciated AI stocks. Even Tesla is one of those, right? Resolve and Poet. These are stocks I talk about on the channel all the time. They're all just under the radar opportunities that Wall Street is not accurately pricing in what their future is going to look like. And that's the easiest way to put it. But that's where I'm investing. That's where we are investing in the trading community. Check that link out down below in the description of today's episode. If you want to come join that, check it out. But with that said, let's get into this clip on CNBC. It's from Wells Fargo. They say the setup for equities into year-end is pretty positive.
Oh-Sung Kwon, he is the chief equity strategist at Wells Fargo, joining us on set. And I know this week's been a little bit weird, but the stock market, we're supposed to buy when prices go down. So you remain bullish.
That's right. I think you buy the dip here. I think the setup for equities into the year end is still pretty positive. We just had actually really good earnings season when companies beat by 8% on EPS. It was actually the broadest beat that we saw in 4 years. 75% of companies beat on EPS.
So what would be, you made the earnings case, the bull side on the earnings side. What would be another bull case for why you think we're going to rally to 7,100?
Yeah, so we came up with 5 different reasons why. Earnings is one of them. The other one is seasonality, which typically gets more positive in November to December, especially for the laggards. So I think there could be a potential catch-up trade into year-end. Number 2, the IEEPA tariff refund, potential refund.
If the Supreme Court rules tariffs illegal, the government is going to have to pay back all the companies for the tariffs that they paid in.
I don't know if they'll actually pay back. I don't know if the checks are actually going to get issued, but I think they'll
reduce future tax obligations. Then it will go to the company's bottom lines.
Yeah, and I think what's going to happen is whether the checks actually get issued or not. What's going to happen is companies that raise prices already, they're going to keep their prices there.
Yeah.
Their costs are just going to come down, so margins are going to improve. So I think there could be potential reflation trade into that potential event in January or so. Number 3, the tax return, that's going to be bigger because of One Big Beautiful Bill. We're talking about $800 more per person versus last year. Number 4, or actually lastly, the government reopening. I think
it will happen.
It will eventually.
I mean, we hope. We don't know when. But it's getting a little sketchy now at the airports. Congress is going to actually have to do its job at some point. Both parties just come together and do your damn job, because that's why you're there and you work for us, not the other way around. Political rant over. But you think that is a good thing for the equity market?
That's what history suggests. And yeah, I think it's going to be an overhang removed for equities.
So those are pretty strong bull reasons why you're at 7,100 by the end of the year. Your job is to analyze risk in part. What would be, if you had to make it, what would be the bear case?
I think it's really the hyperscalers that's a little concerning, because I think this AI capex cycle is still in the early innings. We think we're in the fourth inning of the AI capex cycle, so still in the earlier part. I suspect that this could continue for a little longer than what the market perceives right now. I almost think this is like maintenance capex that companies have to invest in AI to stay competitive. This is not necessarily growth capex to increase their growth rate, but to stay competitive. And if that's the case, their free cash flow is coming down. If you look at their free cash flow conversion versus earnings, it's going to go down to 50%. It used to be at 100%. Their free cash flow margin is going to be at an all-time low. So those are some of the concerning signs for the hyperscalers, which are the biggest companies in the S&P 500.
Can they alone, and that capital spending cycle, we kind of compared it the other day to when the United States built interstates from New York to LA or New York to San Francisco. They did that, and that sort of lifted almost the entire economy because the scale of investment was so big. Is that kind of what we're talking about here, Oh-Sung?
I think the multiplier effect of AI capex is smaller. So I don't think it's not as big of a tailwind as traditional capex. So we actually looked at how many jobs have actually been created from non-res construction versus how many jobs should have been created based on regression. And fewer jobs actually have been created, which means the AI capex cycle has created fewer jobs than what traditional capex would have.
Yeah.
So I think the multiplier effect is lower, and a lot of the layoffs that we saw yesterday from the Challenger data, about 20% of the layoffs were related to AI. So I think
it also means that 80% weren't.
It's the economy. But the way I describe the AI economy is EPS up, layoffs up. It's great for the stock market. It's great for corporates. It's great for especially the big companies who have the access to capital to increase their productivity, but not so much for the real economy.
So I've been pretty clear on my, 2026 expectations. The labor market is going to stabilize. Consumer is going to improve. It takes a long time for the consumer to get past inflation and to start seeing real wage increases. And I think you're starting to, get to that moment, as bad as some of the headlines look like. I think you've seen time pass where inflation is no longer like skyrocketing to the point where people feel like they can't, catch up. Now, sure, are people still struggling? Yes, but inflation is no longer the issue that it was in 2022 and, even 2023, 2021 even. And I think next year the consumer is really going to start to recover. I think we get trade certainty, trade deals, or, the court shut down tariffs. Either way, I think we get a little bit more certainty next year. AI is alive and well. Okay, that's kind of the longer term thesis for 2026. Now, in the next 2 months, in November and December, I think we see a rally from this point because people are so negative. People are so bearish right now that there's a lot of room for an upside surprise at this point. Imagine this. If we got the jobs report for Friday and it was negative 40,000 jobs, that would have been a positive surprise. Yeah, crazy. That's how bearish people are. That's how negative people are on this economy and where things are currently at. And I just think things are probably going to get better into the end of this year. I think things are probably not as bad as expected. Now, in the very near term, it's all about the government reopening. If we get the government open again, that in and of itself is positive, like you've seen on Friday. No, I don't think the Russell's 0.5% move higher was all of what you'd price in if the government reopened. If the government reopens, I think we would have a pretty significant upside move in markets. And, I think we're probably going to see the government reopen by Monday. I think there's a lot of pressure to get the government open at this point. and I think it's almost inevitable. So let me know your thoughts on this down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. Come join the trading community if you guys would like to be a part of this journey with us. Come find these under the radar AI stocks and come invest in them with us. That is what we are doing 7 days a week, even, over the weekend. Like, a lot of people want to take the weekends off, and that's fine if you do, but we don't. We go out research. We go find those hidden gems, and I think we've identified some pretty compelling opportunities, to say the least. So that is it, ladies and gentlemen. Have a great rest of your day, and I will see you in the next one.